We'll get started. Welcome to our webinar on social and sustainable bonds. Today we are going to discuss about the characteristics and positive impact of these bonds, our joint Solactive and CBI index, and we will also venture an outlook on the social bond market and its potential challenges. But before we get into that, let me briefly introduce myself and my panelists. My name is Vanessa Goltz and I'm working as an ESG specialist at Solactive. I'm mainly responsible for our corporate sustainability efforts, but also support strategic product development and advisory in the area of ESG. Our external guest today is Candice Partridge. She is the Senior Sustainable Debt Manager at Climate Bonds Initiative, where she has been instrumental in the creation of the social and sustainability database by leading the methodology development and conducting bond analysis. She helps to aggregate relevant bonds and keeps a close watch on developments in the market. She also specializes in the US green municipal market, which she focused on in her doctoral research. Alexander Weiss is our head of fixed income product development at Solactive. He has been leading the team since October 2019, guiding the development of cutting-edge products and strategies. Alex brings a wealth of experience from his tenure as Senior Relationship Manager Institutional Clients at the DZ Bank, where he built and nurtured strong client relationships while providing tailored financial solutions. Welcome to you too. Solactive and the Climate Bond Initiative have a long-standing partnership as we created the first Green Bond Index together in 2014. And I'm very happy that we are continuing this excellent collaboration now in the social bond space as well. Now, before we really get started with the discussion, let me say one last organizational thing. We will have a Q&A session at the end, so please feel free to write any questions you have during the discussion in the Q&A field in Zoom, and we will come back to that later. Let's start with the reason why we're all here today. Alex, why did you and your team decide to launch the Solactive Social and Sustainable Bond Index?
To be honest, since I started my career with Solactive a couple of years ago, our CEO has been breathing down my neck to come up with a social and sustainable bond index.
Oh, really? Okay, then maybe I should ask, why did it take so long?
Yeah, I guess he is also interested in that question. So actually, I guess everyone knows that kind of problematic around available and reliable and consistent data sets that you need to have to come up with products. So unfortunately, there was nothing in the space that we at least considered to be such a kind of database. Luckily, we were in close contact together with CBI based on the Green Bond Index projects that we launched with them. And actually, during the development of this database over the course of the last, let's say, 2.5 years, we exchanged between CBI and Solactive, and we even conducted joint client meetings where we actually presented our services and also took the feedback from the clients in order to come up with a proper solution. To come back on the original question, why we launched this index, as you mentioned already, it feels like a little bit of a natural development. We were the first with a green bond index based on the CBI data. So of course, we also decided to be the first one with the social and sustainable bond index. A part of that, I think there are also the current developments in the market around sustainable or impact investment rather. So we do have various challenges. On the one hand, there are the typical topics that need to be tackled, like education, infrastructure, affordable housing, healthcare. On the other hand, there are, like especially for developed economies, problems around aging population. And unfortunately, there are also some external factors like wars, conflicts, growing social unrest, where we think there will be, on the one hand, kind of demand for funding these kind of projects in these areas. And on the other hand, our clients are looking for solutions to actually twist their current investments into more impact-oriented investments. So I guess we have like both things. We have the demand for such products, and at the same time, we also have the offer of such products.
Okay, now we heard a lot about Solactive's motivation to create an index like that, but what is a social and sustainable bond?
Well, very easy from my side. The definition goes by the use of proceeds of a bond, of an instrument, let's say. And actually, as long as it has a positive social outcome with regards to the projects that are financed or refinanced, this instrument can be regarded as a sustainable bond. But frankly speaking, I guess, Candace, you can spend probably a tad more on the details around that, what a social and sustainable bond is.
Indeed, I could speak at great length about this, but let's try to keep it simple at first. So this is a slide that I provided where it tries to sort of illustrate, and it gives context as to why this data set even came into being. Climate bonds obviously started with green bonds, and we've been screening green bonds for a very long time now. In the past few years, we had this increasing trend of especially sustainability bonds that were hitting the green bond analyst desk. For us to include a green bond in our database, for us to consider it aligned, it has to have 100% climate aligned use of proceeds. We were getting sustainability bonds, which had a really great climate message, but also had social tacked onto the end of it. It's not to say that they're bad bonds, it's just that they didn't fit with the 100% remit of having climate aligned only. We're having to exclude bonds that are actually really good, instruments for trying to foster change in the world. Off the back of this, we created, it was almost a holding area. Like, we consider these to be beneficial to the world at large, but they don't currently fit with our message. So what are we going to do with this? Those bonds ended up becoming the core, the beginnings of the social and sustainability database. So I came on as essentially a product and a project manager to launch this database. I received this nascent set of bonds that were social and sustainability bonds. So what is a social and sustainability bond? A sustainability bond is basically a hybrid of a green bond and a social bond. A social bond is strictly social-facing use of proceeds. Things like affordable housing people, feeding them, food security. There were a lot of social bonds obviously issued at the height of COVID around employment and just social restructuring and regeneration. So anything that's sort of fostering the social good, but with no clear climate benefit, is considered a social bond. Healthcare, education, these are the bread and butter of social bonds. They do very good things in the world, and they're actually considered part of our core message because part of climate resilience is also social resilience. So this is why we didn't want to just throw them away, like they were worthy of having their own data product. A sustainability bond is the hybrid of social use of proceeds and green use of proceeds. When done well, a sustainability bond, in my opinion, and I'm clearly biased, is the best in class of a use of proceeds bond because it's trying to physically save the world while also socially save the world. It is the best. It is unclear at times what the standards are around this. So we've been a market pioneer. Many people on this call may be aware the EU is attempting to do a social taxonomy that's been put on hold. There is obviously the green taxonomy. So what led us to being a little bit later to the market was that there's no clear market guidelines around what constitutes a beneficial social use of proceeds. And we've kind of just had to dip our toes in and see how we go. So we have created a methodology around our screening process for social bonds and sustainability bonds. And we give an outline of what we consider to be eligible. We also give an outline of what we consider to be a transgression against climate safeguards, because as climate bonds, even for a purely social bond, we still view it through a climate lens. So they come out under a panoply of labels. Like during COVID, we had a lot of pandemic bonds, which were essentially social bonds. A sustainability bond, you could see under SDG, sustainable development is one of my favorite ones. Like, what does that actually mean? We have to really unpack what are the meaning behind these bonds. ESG, people throw around ESG as a term, and in thematic debt, it doesn't mean what other people think it means. So again, we have to be careful with the terminology. One advantage of this data set is that we take the initial labels that come to market with the bond and essentially translate it through its use of proceeds into what we consider the theme. So we have only really two themes, social and sustainability. So when you look at our data, we're kind of translating, like when you see a sustainable development bond, is it a social bond or is it a sustainability bond? We give you a shorthand for that. So our screening approach, and this is outlined in our methodology, which is available on our website. The first thing we essentially demand right off the bat is we need to see a label. We want an indicator from the issuer that they wanted to distinguish their issuance from the norm. Even though, again, my background is in muni bonds, a great deal of municipal debt in the US could be considered, of social benefit. It's for the public good. But without putting a label on it, the issuer is not indicating that they are willing to be different. So that's step one. Well, first has to be a debt instrument, obviously. Step two, self-labeled. Step three, sufficient disclosure. We need to see either a framework or some sort of use of proceeds that tells me exactly what you're getting up to when you issued this bond. What are the projects that you're financing? What is the money going to? So yes, we take the bonds, we try to find all the identifiers for them that are relevant, ISINs, CUSIP, short codes, depending on which market it's coming from. We tear apart the use of proceeds to see what exactly is going on in this bond. We code it into different categories. We have use of proceeds categories for social. We have use of proceeds categories for green. If it's a sustainability bond, it gets both. If it's just social, it just gets social. And then we key it against the SDGs. They're literally on my wall here. I have them memorized, but they're on my wall. I want a poster. SDG 1, no poverty. SDG 4, education. So we go ahead and code those. So frequently when you open up SBOs or frameworks, they will attempt to list their SDGs, but we kind of throw that out and redo it again. So this is what we believe to our, according to best practice, what we believe are the relevant SDGs. So that's another unique selling feature of our data set. We do exclusions. So, and this can be contentious sometimes. We do exclusions, especially for, like I previously mentioned, sometimes we get social bonds that may be of social benefit. But if they involve anything to do with detrimental climate effects, we're going to have to exclude them because we are Climate Bonds Initiative, and this is our mandate, it's our fundamental purpose. So that is a slight difference. Like other, index providers or asset managers may look at a social bond under a different lens of purely social and be fine with whatever they do. A huge point of contention for us is road infrastructure. Initially, we allowed no roads at all. Now we do allow roads in emerging markets, developing countries only. It's kind of a case-by-case basis. Anything that is adjacent to fossil fuel transport, exploration, use, those are out. Weapons, definitely out. Frequently, we find that we had to exclude bonds because we've asked the issuer to explain something to us or to give us sufficient disclosure. And they don't. We give them a time frame, a very generous time frame to respond. And if they don't, then we just eventually have to take a view and exclude them. And then very frequently, we will see bonds that are nominally use of proceeds bonds, but when you tear them apart and look at the actual use of proceeds, they'll say they're for general capital, which is not acceptable to us. We have to show that the projects being financed, that the money is earmarked for those projects that are in alignment with our standards. So, yeah, general capital is out. And in the case of social bonds, we'd like to see a target population. So you need to indicate to us who you are trying to benefit and how.
That's really very interesting. Thank you very much for that. Yeah, as I already mentioned, Solactive and CBI created the first Green Bond Index together. And in March, we launched the Social and Sustainability Bond Index. Alex, could you tell us more about this index? How does the index universe look like?
Yeah, sure. Well, technically speaking, we chose the same approach as we chose with the Green Bond Index. So basically, the index offers an exposure to global social and sustainable bonds. So it is a very broad, or the broadest available universe, so to say, you can look at. All the bonds need to be screened by CBI, obviously, and they need to be flagged as social and sustainable bonds. We focus on bonds that have like an amount of issuance that is equal to or larger than 300 million. So we cut off all the small issues that are most probably highly illiquid. And we also only include securities that have a maturity of more than 18 months. And once a security in the index has a maturity of less than 12 months, we also exclude that from the index. We are focusing on plain vanilla bonds. So basically all kind of extraordinary bonds like convertible bonds, US municipal bonds, for example, structured credits, any kind of those bonds are excluded from the index.
Okay, now we know the different selection criteria, but what does that mean in practice? So what does the current composition look like?
Yeah, let me probably explain that a little bit with the graph that we are just looking at. What we see here is the comparison of the social and sustainable bond index to our green bond index and also to our VARBIC. The VARBIC index is a very broad market index reflecting investment grade securities. So basically, this is an index that has more than 23,000 constituents. So a really broad universe you're looking at. And what you can see from the graph immediately is you are not investing in any kind of exotic universe or any kind of awkward risk return profile, right? So what you can see here, basically both the green bond index as well as the social and sustainable bond index reflect somehow a kind of market return, let's say. If you go into the details, you see similarities, of course, on the one hand between social and sustainable bond and the green bond index. As you can also see from the graph, although I wouldn't rely on that too much because just the history is a little bit short here. But as you can see from the graph, with both social and green bonds, you can obviously achieve a kind of outperformance vis-a-vis a global market portfolio. Talking about the details, so in the social and sustainable bond index, we have roughly 950 securities included from 460 issuers. If you compare that to the green bond index, we have obviously half of the universe, so to say. The rest of the index is relatively similar to the green bond index, so there is a vast majority of government bonds and also government-related issuers. The rest is corporate bonds, mostly from the finance sector, so that's also quite comparable. And if you look into, for example, currencies, you can see that euro and US dollar are the majority of the issuance in those kind of indices. There is some kind of speciality around the social and sustainable bond index. I guess, Candace, you will probably drop a few words around that. France is quite an issuer, obviously, in the social and sustainable bond universe. When it comes to risk return profiles, you see we have an average rating of AA-, both in the green bond index as well as in the social and sustainable bond index. We have a very similar average duration. And also, if you look at the return profile, so average OIS spread is also comparable between the green bond index and the social and sustainable bond index.
Okay, it's great to see that many governments decide to tackle the financing of social issues like that. And I would like to know more about the use cases of these bonds. Maybe, Candace, you can give us some examples of the projects that are financed with these bonds.
Absolutely. So yeah, France is pretty much exceptional. I do not speak French because I'm American and British, so I'm a typical Anglophone. But essentially, France has, I believe, the acronym CADES. CADES is issuing the largest tranches of social bonds that we see anywhere in the market. And it's essentially to underpin French social security. So it's access to healthcare and employment and essentially welfare. So I love to see that they have programmatically decided to label their debt as social bonds to indicate that this is what they're doing. Again, other countries could do the same if they could identify that their use of proceeds is eligible. They could do the same, but France has been a real vanguard in that, and they are one of our largest issuers for sure. Other large issuers, Fannie Mae and Freddie Mac in the US issue both social and sustainability bonds. And we love to see that as well. They are another one of my largest issuers. There's a lot of affordable housing in this database. And on that point, that's one of the things I would like to tighten up our criteria around is when we say affordable housing, especially in America, what are we talking about? Because what we say in America may mean something totally different from elsewhere. So this is something that we're going to have to navigate pretty soon. I'll get clarity around that issue. Other interesting social bonds, Council of Europe Development Bank has been coming to market recently, again, with employment, re-education, helping people to stay in jobs and to stay in the job market and to improve social resilience. And then another interesting sustainability bond that has come to market, interestingly enough, is Mars, which, again, these large food providers, you could raise a lot of red flags around them. But when we see them trying to do good and have good use of proceeds, especially around transport systems and energy efficiency in their warehouses, et cetera, they're trying to do good and they're trying to create employment opportunities for people. Yeah, these are interesting things to see in the market. We love to see it.
Yeah, it's really interesting. It really shows also the importance of investment opportunities like these. And yeah, the financing need is really very high to solve all these different problems. And it's great that social and sustainable bonds can help address these problems and bridge the funding gap. Alex, yeah, maybe you could explain why, as a customer, one should select Solactive as an index provider for this topic. And maybe also why fixed income is the right asset class for this topic.
Sure. Yeah, so let's probably start first with why Solactive. I think that's pretty clear to everyone. So Solactive has a long history with regards to topics around ESG, social responsibility, biodiversity, women empowerment, gender equality. I mean, I can now list all the awards that we got during the last couple of years. But what I would like to express here, there is a lot of experience we bring to the desk when we are discussing these kind of problems or projects with customers. And actually, to be honest with you, in most of these cases, we were actually pioneering the index industry. So you mentioned it already. We were the first with the fixed income green bond index. We were the first with a fixed income PAB solution, CTB solution. We have a unique PAB solution for governments available. Now we launched the first social and sustainable bond index based on the CBI data. And there are many more projects, even on the equity side, where we really were the first with certain topics. So I guess it's pretty clear if you look into like sustainable investments, you need to talk to Solactive really.
That sounds very convincing.
The most important thing about Solactive is not only the experience in the field of ESG investing, but the flexibility. I think that's the key advantage compared to other index providers. We have an open platform, so we basically and literally can apply anything to our indices. That varies from, for example, data vendors like CBI, where we use the data of those kind of vendors. But that also includes proprietary client data that we can apply to indices and at any kind of level. So a simple exclusion list is definitely doable, but also any kind of optimization with regards to a proprietary ESG approach that might be on the client side in place. Yeah, that's basically it, why Solactive should be considered when you're looking into fixed income indices. Coming to fixed income itself, I think it's quite obvious that there was a bit of a change in markets. So the last decade, let's say, was probably the most interesting decade when it comes to fixed income. There were low yields or even negative yields. Only investors that were forced for regulatory reasons, for example, to invest into fixed income were invested in fixed income. But everyone who was able to avoid that avoided it. And if you look in particular to last year, it was very painful. For example, our VABIC index, our broad index, made an underperformance of roughly 20%. That's really painful. But I guess there's also this opinion in the market that we have seen most of the, let's say, repricing in fixed income. And actually, it is quite interesting to invest in fixed income again. So there are opportunities even in the money market space where you actually can gain more on a money market investment compared to an equity investment. I think that's something that was like a long time ago we have witnessing such circumstances. So definitely fixed income is or had a kind of renaissance, let's say. And of course, just for diversification reasons, you cannot avoid fixed income forever, right? I think now it's the right time to also look into fixed income. And the combination of like looking into fixed income and combine that with impact investments is the most interesting part of it.
Yeah, I totally agree. That's really a good way to combine fixed income and impact investing. Also, yeah, either via green bonds or also social and sustainable bonds.
Yeah, and actually, what is probably also important to mention here, I see these indices like the green bond index or the social and sustainable bond index not that much as the index you need to license, right? We can use that as a tool. So if you want to dive into specific market niches, if you want to like look into euro-denominated debt, it is always worth to look, for example, at the green bond or social and sustainable bond index. For example, to make your portfolio or the portfolio you are aiming at even more sustainable, even more impact-oriented. So what we can think of is a slicing and dicing of these kind of indices, as they are really broad, and not all the clients are investing in all currencies and all country areas, etc., etc. So these indices really are more a tool to also enhance existing or aimed, let's say, portfolios and security universes.
Yeah, flexibility is definitely one of our strengths. Yeah, so before we open up for the Q&A session, I would now like to look into the future of the social bond market with you too. Candace, what are your views on how the market for social and sustainable bonds will develop in the next years, and what are or will be the opportunities and challenges ahead?
It's a really great question. So I feel like 2023 is shaping up to be very, it's June the 1st. How is it, the year's almost half gone. So what is happening? I'm seeing that there's a lot of interest from not just issuers, but also investors around biodiversity, which we do not currently have as a category. There's a paucity of data. So I foresee a lot of interest and perhaps methodology development around biodiversity coming up, both on the green and the social and sustainability side. This ties in with agrisystems and food security as well. So there's a lot of interest in that. I mentioned previously affordable housing. Affordable housing is a huge section of our database, and I'd like to create some additional rigor around that. At the beginning of the year, I was asked to do a forecast for internal uses, and I basically pushed back. And it's because a year and a half ago, I did a forecast, and then the Russia-Ukraine war broke out and the numbers did not materialize. So I don't really want to come out with a forecast for the year in terms of numbers. I will say that I think that we're on track for a pretty solid recovery. The slide here shows you the numbers. This is based on the global state of the market that Climate Bonds just released. I think it just went to press. So this is based on 2022 figures. You could see that issuance in 2022 was down. This is GSS plus, so this includes green and SLB as well as social and sustainability. So the numbers were down. But I can say, you can see the top of the chart here, it was trending when this chart was created towards 4 trillion. And I can confidently say that, we're going to surpass 4 trillion this year in thematic debt, which is amazing. You can go to the next slide. In terms of actual breakdown, this gives breakdowns by label. We have, green is still the juggernaut so far in thematic debt, but I keep telling my green team, I now manage all products. So I tell the green team, like, get ready, because SNS is still growing. It's still clipping at their heels. So we're prepared for kind of market parity between green and SNS coming soon. I thought it would happen this year, but I don't think it will be this year. So we had 2.2 trillion outstanding and what issuance for green, 653 social, and sustainability 682. And I told Alexander I was pulling the numbers for this webinar to see what is the year to date. So these are not formally sanctioned. These are not in the report, but like, what's the trend year to date? Year to date so far, I see over 100 billion in issuance for, this is just SNS. And interestingly, I see parity, a same amount of issuance for social as sustainability, which usually, historically, it's been sustainability has been the larger issuance. You could see there's usually fewer number of issues, but larger bonds come into market. So they usually dominate in terms of numerical issuance. This year, the trend, at least for the first half of the year, looks like their social and sustainability are on even playing field. So I think that's very interesting. It could be that during the pandemic, actually social dominated. Who knows? Who knows what's going to happen next year, and who knows what's going to happen the rest of the year? But yeah, the market is holding strong. I don't know if we'll see the same number of growth numbers that we've seen in the past, but certainly no decrease. So this is really reassuring to see.
Yeah, that's really great to hear. Alex, what is your perspective on that? And what do you think will be the next topics going forward within sustainable debt?
Yeah, I'm pretty sure that there is enough demand for funding projects in that field. And this funding demand is meeting like investment demand. So I'm pretty sure that we will see more growth in that area. I'm really convinced about that. A part of that, I guess, there will be other developments also coming up, right? And Candice, we already discussed it in some of our meetings. So there are other developments around blue bonds, for example. I guess that's the latest label that has been raised in the market. But we were also already discussing transition bonds, brown bonds, or whatever you call them. I think there are even other topics not related to certain bond labels, but also to certain topics in that area. So I guess we will see biodiversity, natural capital. These are the topics that will come up relatively soon, I guess. And also, what is probably worth to mention, I know in the green bond and social and sustainable bond case, we are quite often seeing governments, but actually in other topics, governments are quite often excluded from the data source. So this is also something where I see some development, that we get more data on governments to be able to also make a more reliable choice for certain governments that actually comply with environmental and the like goals.
Great, thank you. That sounds really promising, and I hope that social and sustainable bonds will have a great impact in the future, and of course also the other kinds of bonds you mentioned. Yeah, so now we have time for your questions, dear audience. I saw that some of you already wrote something in the chat, but of course you still have the chance to do so. We have another 25 minutes, so just let me have a look, and we will start with the first question. Okay, someone would like to know how you define social and sustainable bonds. How would you put ESG overlay on corporate bonds, or are you just picking green bonds that are specifically made for impact?
I'll go ahead and take that. These are not green bonds. Green bonds are, like I said, they're different labels that come to market. The green bonds are in a different data set. So these are not green bonds. These are bonds that have come to market with either a social or a sustainability issuer assigned label. So we define them, again, social bonds are bonds that have use of proceeds that are strictly for social impact benefit. We don't measure the impacts of that. We just look at what they're for. So feel free to download our methodology. We go through the categories there. And sustainability bonds are bonds that are hybrids of green with social use of proceeds as well. And do we put an ESG overlay on corporate bonds? It's not really about ESG overlay. Corporate bonds are welcome to come to the market. They just need to put a label on it. So like I said, Mars has come to market with a sustainability bond. So it's not really about an ESG overlay. This is kind of where the conflation between ESG and thematic debt occurs. There's some friction around the terminology. ESG is really more of an equities focused tactic. It's not that we are adjacent to ESG because this is about environment, this is about social, and this is about governance. So we are adjacent to ESG, it's a different lens. Thematic debt works differently from ESG indicators and metrics that you use for equities investing. Alexander, would you like to add to that?
Yeah, maybe what I would drop from the indexing perspective, what we usually do in some cases is we do it the other way around. So for example, we have a PAB concept in place for a client, and actually we enhance this PAB concept by emphasizing, for example, green and social and sustainable bonds. So they get a higher weight within the index portfolio, let's say. So certainly this is something that we have seen and that we actually also have in live indices available. The same is true for other kind of use cases. So once a client comes to ourselves and wants to implement their own ESG approach, we quite often get asked whether there are opportunities to actually overweight specific bonds that have like this kind of impact investment approach.
Okay, great. Next question. Are there any additional factors beyond interest rate fluctuations that can affect the performance of sustainable bonds? Who wants to take that one?
I mean, on the fixed income side, the performance is clearly driven by the creditworthiness of the issuer. And in terms of social and sustainable bond, the majority of those issuers are either government or government related. Usually also these kind of issuers have a relatively good rating. With regards to the corporate side, I would say it applies the same as for usual corporate bonds. Once there are problems with the issuer, you clearly should avoid these kind of issuers. The question is whether there is a kind of premium you could earn potentially with social and sustainable bonds vis-a-vis, let's say, plain vanilla bonds. Actually, we had a look into that. There is a research available from our side. We can of course share that also afterwards. Unfortunately, the time horizon is a tad too short to really give a precise answer on that. But actually, it seems there is like something similar as on the green bond side, some kind of premium.
Okay, a question related to that actually. Has there been evidence of social or sustainability bond issuance leading to lower financing costs for issuers?
Yeah, as I said, probably more research around that needs to be done. I guess so, but this is more anecdotal evidence, let's say.
I'd agree with that as well. I actually have experience doing greenium research on the green bond side, and so there's easier cases to point out on the green bonds, but they are present in the market for a much longer time horizon. So this is a new market sector. I would really love to be able to unpack this professionally. This is my professional interest. So I echo this question. This is a great question. I suspect if we delve into it, we would probably find evidence of it, but we just need to be able to take the time to do the deep dive into it. Climate bonds does do, I think we're starting to dip a toe into this. My colleague Caroline issues periodic reports about green bond pricing dynamics, and I believe she's starting to look at alternative labels like sustainability and SLB. So if you have an interest in greenium or socium, please go to our website and look at our pricing papers, because she puts a lot of work into them. They're really great.
Okay, that's a great hint. We're going to the next question. What are the prospects of such sustainable and social bonds in emerging and developing markets?
This is a really great question. I think that there's a lot of leeway here. There's a lot of runway for these bonds to help foster sustainable development in these emerging markets. And you can see this because the bulk of these bonds currently are being emitted by the supranationals, so the development banks. So the tricky aspect of these is that in emerging markets, they tend to have an energy mix that is essentially hostile to what we would consider to be eligible. And this is where social bonds run up against our climate criteria. So essentially, if you want to make energy cheaper and more accessible to impoverished populations, but that relies on natural gas or coal, I'm going to have to exclude it. So it can be very tricky to navigate. So I believe that there's a lot of latitude here for using these particular bonds for the forces of good, but we at Climate Bonds are kind of in the position of being the enforcers of they must also not degrade the environment. And this is something we take very seriously. So if you see a bond listed as aligned, it's because we have really gone into it and looked at it. And so, you know, it's difficult to decarbonize emerging markets. Is going to be a difficult task. And I'm not sure that essentially, I think this is where transition bonds and other assets may come into play. But that's not to say that there isn't room for this. Like, for example, Mexico's issued sovereign sustainability bonds that are very comprehensive and all-encompassing across both green and social use of proceeds. They've done very well. I really like their debt program. Colombia is very active in this space as well. So we try to be as inclusive as possible while ensuring climate safeguards.
Okay. How objectively defined are positive social outcomes? For example, if culture A considers a given social outcome positive and culture B doesn't, how do you account for this divergence?
Currently, we just have one global standard, which kind of feeds into the last question. We have one global standard to increase uniformity across all debt issued. That isn't to say that we should impose a unified standard across everything. We wrestle with this, frankly. And this is why initially in the very first version of our methodology, roads were a hard blanket exclusion. And I felt as if that was too restrictive, especially, for example, Mexico, part of their debt program was doing last mile roads to improve access to hospitals and schools and villages. We shouldn't be too draconian about that type of development. So we loosened the criteria to include it on a case-by-case basis where we can see positive social benefit for that. So one size does not fit all. Currently, we enforce it that way because we do nonetheless have to hold, climate emissions, we all breathe the same air, we all exist in the same biosphere. So at the end of the day, we do kind of have to have a one size fits all when it comes to climate safeguards. That's not as true for social. And so this is something that this is a space to watch, definitely.
Yeah, okay, I see. Then there's another question. How long does it take for a new social or sustainable bond to be included in the CBI database?
We screen it, we do weekly screenings. So if it hits the market, you'll see it in the data release. Our data releases are monthly, but we do weekly screening cycle. So it'll be included within the week, assuming there's no clear issues. If there's issues we have to query, that will lead to a considerable lag time, depending on the responsiveness of whoever we're querying. But once the issues are cleared, it goes straight in, and then you'll see it in the next month's release.
Okay. And the next question, what is the difference between sustainability bonds and SLBs?
Alexander, do you want to do this one? I'm going to let you do this one.
Not really.
I know, I feel like a broken record.
I guess the difference between those is that, well, social and sustainable bonds have a clear use of proceeds definition, whereas it is a tad unclear on the SNS bonds. So, and I guess that's also reflected in your methodology, right?
I'll unpick it a little bit. Sustainability linked bonds are not use of proceeds bonds. They're usually general capital bonds. They just have some sort of KPI target. So they're saying, we're going to do business as usual, but we are going to reduce our emissions by X amount by 2025. And if we don't, then we're going to have a penalty on our interest payments. So this is why they're considered very different from use of proceeds. They're still general capital. We just cannot allow that. Now, we do have some hybrid instruments in the database. We do have a couple of green labeled and social labeled bonds that have SLB-like impact metrics that they're trying to hit. That's fine. If they've restricted their use of proceeds with a target, we can give them a cross label and include them in both databases. But SLBs are a very different beast because they're not about use of proceeds generally. Generally, they are general capital with targets.
Okay, thank you. So the last question up to now, but you still have time to ask other questions. It's a more general question. So how is ESG in general integrated into an index?
Wow, that's a very general question, really. So it really depends. So you can have like the easiest implementation by just applying some ESG data points that we, for example, gather from either Sustainalytics or ISS or whatever kind of data vendor that is able to provide ESG data. I would say the more sophisticated clients on our end, they have their own ESG approach. They even have their own ESG scores per corporate. So actually they have a heavy research department, so to say, who really look into the individual companies and the individual bonds. And it can be very complicated, so to say. So we do have indices where we actually include several optimizations for various universes and then bring that together into one index universe. For example, we did that with our Warwick index. So you have like govies included there, you have agencies included there, you have corporate bonds, you have structured funds. And for all the individual universes, you need to, of course, come up with ESG figures that actually make sense, right? That actually lead to the desired outcome. Yeah, so as I said, it could be very easy, but it can also be very, very complicated.
Okay, so we still have a few minutes left. There are no more questions at the moment. Any last words you want to say, Alex or Candice, to our audience today?
Candice, would you like to start off with a closing comment?
Sure. I would just like to say that I actually feel like social sustainability is a very vibrant and growing space. And again, I wear all hats. So I started off with green bonds, but in a way, I almost feel like green bonds has become myopic, like restrictive. And so I love that this has more of a social lens. At the end of the day, I'm really interested in resilience, both in terms of climate and in terms of societal. So I just get very excited about social and sustainability debt and what it's trying to accomplish. That said, I'd like to see improved standards and rigor. So if anyone's out there listening that is, adjacent to taxonomy development or standards development, please, let's collaborate, let's get together, because I need reinforcements on that front desperately. We don't want to let our guards down, essentially. We want to make sure that the market is doing good things. So it's a very exciting space. It's very new. This is a very, very new sector and a new product, but it's growing very rapidly and it's exciting. So there you go.
Thank you.
I just can share that I'm also convinced that the trend of the recent years will hold. So if you look into the index projects that we had during the last couple of years, we can clearly see that there is a growing share of indices that are somehow connected to environmental impact or any kind of climate related topics. And yeah, I'm looking forward to these kind of conversations. Of course, also around social and sustainable bonds, green bonds, whatever your interest and demand is, please let us know. And I would like to thank the audience for the time today.
Yeah, perfect. Now we're already at the end of our webinar, and I hope you enjoyed it as much as I did to explore the world of social and sustainable bonds combined with indexing. If you have any more questions, please feel free to contact us. Here you can see our contact details, and we will be happy to provide answers. And we are also very happy to receive your feedback on our webinar today. Candice, Alex, I thank you both very much for joining our webinar today. It was very interesting to hear your insights and perspectives. And to our audience, thank you very much for participating and asking so many interesting questions. Let's keep the discussion going and let's make a difference together. Thank you very much.
Thank you. Goodbye.
Thank you so much.
Bye.